Check out energy leading the market today, jumping nearly 3%. The group trying to stage a rebound after a rough couple of weeks. Our next guest says the recent drop could be a good signal for the space. Let's go off the charts with Oppenheimer's Ari Wald. Ari, what are you looking at?
Yeah, I'm looking at the sell-off we've seen in the sector in recent weeks. I think it's telling that the bear cycle has now come for the leaders. It was the one sector that was still holding up, holding trend, holding their 200-day average. I do see that as a sign as the leaders surrender that we're closer to the end of the decline rather than the beginning. With that said, if the S&P 500 is going to form a W pattern over the coming months, which is to say it's going to form a double bottom and there's going to be some backing and filling here, I think energy needs it as well. Here are the support levels I'm watching. Comes in at the 200-day average first at $67. And then if you were to overshoot here, if things get pretty ugly in the third quarter, $61 does mark the January breakout above the 2020 peak. But listen, the sector is still down 21% from its recent high, and I think that long-term trend does indicate you want to buy these pullbacks. So at the very least, let's key on some of the best in the sector, stocks you want to that I think could withstand some additional near-term volatility that you want to own for the long term. And the standout for us is ConocoPhillips. Why? It's one of the few stocks in the sector that already broke above both the 2014 and the 2018 highs. The XLE wasn't able to do that. So to us, that's an indication of long-term leadership and one of the names to be looking for on this pullback in the sector.
It's interesting, and I'm not looking to play stock market here, but the OIH went from 317 to 220 in seemingly 6 trading days. It was not commensurate with either the move in the commodity or the broader market. So it seems like people were selling first, asking questions later, which leads me to believe, in our vernacular, a lot of tourists in the energy space. Does that concern you at all?
Yeah, I mean, and it's just a sector that just had this extreme run up. The year-over-year rate of change at its highest point up at 100%. That year-over-year has only gotten above 60% a handful of times, looking at a century of data for that sector, going back to the 1930s. So some additional time is required in the sector, in the market overall. I'd follow that roadmap, even tech coming off the collapse in 2003. Financials in 2009 would be an example, too. After this extended decline energy had for a number of years, this parabolic rise, it would be historically unprecedented for it to continue at that current pace. So, which is just to say, expect the returns to start to slow here. Pullback should still be bought, but you're not going to see the pace of gains continue as it was.
Before we let you go, Ari, can you give us your quick take on what we're in for in terms of the markets and rates?
Yeah, I think the key positive for, let's start with the market, is just how washed out it is. Nobody loves it. Nobody likes it, or based on the sentiment polls, at least, the II bull-bear ratio at 0.6. So that is an argument for the long term. Typically, when you see the sentiment pendulum swing to such extreme levels of pessimism, good long-term buying opportunity, that extreme pessimism can linger over the near term. So perhaps an indication too late to sell. Is it too early to buy? I think utilizing a more conservative approach where you're waiting for the base building makes sense, especially when you consider midterm year seasonals as well, leads us to believe the market should base through the third quarter, lead to a Q4 upturn in the cycle. And yes, I think you need rates to top out here too. The 10-year testing that very important 2018 high at 3.25. I think if you get a top in rates, the growth stocks will find a floor, and that'll act as your bottom for the equity market too.
Ari, great to get your take. Thank you.
Thank you, Melissa.
Ari Wald of Oppenheimer. Dan, what do you think?
You know, interesting on the energy stuff. We were here a couple weeks ago. It was June 8th, and everybody couldn't stop talking about Exxon making new all-time highs, broke out above for a brief moment above their 2014 high, and we were kind of like rolling our eyes. And you've had the call, right? I know Tim's been on this, that, ride this energy trade, ride crude oil, buy the dips. But when XLE, from that moment, okay, we know that Chevron and Exxon are about 40% of that ETF. It went down 25% in a straight line in 2 weeks. So here we are now at this kind of $70 level. And I know that some people think that, it was just a lot of tourism, right? A lot of people just kind of crowding into this trade. XLE probably lines up pretty well. You wouldn't be selling it right here, especially if you think that a lot of these inflationary pressures are going to be persistent. So to me, XLE could line up as a decent trade here off the
Funny, Dan mentions ExxonMobil, Courtney. Wasn't that one of your picks? Wasn't that your final trade?
That was, yes.
Yeah.
On June 8th?
No, a little later than June 8th.
Okay.
No, I still really like the energy trade. I mean, ultimately, you have this huge supply-demand issue. We're still seeing people are traveling. People are getting out and driving, despite the fact that gas prices are increasing. That demand is not going anywhere. So I really think, yeah, these dips are opportunities to be bought. I think that's only going to continue if there's further dips. Just take advantage of that right now.
Karen, what do you think is the best way in your portfolio to play inflation? Would it be energy or would it be something else?
Oh, that is a great question. I think, to me, it's high tech, high multiple tech names, right? The higher inflation goes, the more the Fed needs to tighten. And those two, the correlation between those two, or the negative correlation, is very strong. So short IGV.